The barbell approach is like for a portfolio, okay? Hedge your extreme risk, hedge your extreme negative risk, and take maximal positive risk. How to make something robust? To make something robust, there are two things. Because of Jensen's inequality, it's better to walk and sprint rather than just jog. So you have strategies that have variations in them. Bipolar strategies are vastly better than mono strategies. And you see it, for example, with portfolios. It's much better to put 80% of your money risk-free if you can find something like that, and 20% speculative, rather than the whole thing medium risk. Much more robust that way. But you can see it in the policy of every single monogamous species, which includes humans, we know we have data for birds. Monogamous birds, typically, instead of the female opting for a good match, she picks the accountant 90% of the time and the rock star to cheat with 10% of the time, for a linear combination of having someone in the middle, you see? So the idea, you take the loser but stable accountant and something like not that accountants are losers, but you see the kind, all right? And then you have the hotshot rock star on the occasion. So the linear combination is better. This is explained in the book why things that have variation, and I use the very same equation of Jensen's inequality to show why it's a lot more stable. The barbell approach is like for a portfolio, okay? Hedge your extreme risk, you see? Hedge your extreme negative risk, and take maximal positive risk.
I would say if you're looking at beating the market, so alpha, I don't do that in hands-off styles of investing. I have that very much on one side of my barbell. So I personally, partially by choice and partially by fate, have ended up with a very barbell looking asset distribution. And if you were to look at what I have, you're going to have highly volatile, what most people would consider highly risky class of investments, namely startups and cryptocurrency. That's going to be more than 50% of my total assets. And then you have real estate and cash or cash-like equivalents. And that's pretty much it. So on opposite ends of the spectrum, and we could debate whether or not real estate is risky. We could debate the benefits of cash if you also have to contend with inflation. But let's just keep it simple for the sake of this discussion and say that you have highly volatile, what most people would consider high risk, high reward categories like privately held startups and cryptocurrency on one end of the barbell, which is where I create my alpha. And then you have real estate, cash-like equivalents, and things like, for instance, muni bonds and so on, where you would then preserve that alpha. Okay, so you create alpha, take it off the table, and then preserve alpha. Now, forget about the question of converting crypto into fiat or keeping it in crypto. Let's just keep it simple. So that is currently what my, say, asset allocation would look like. That is very, very likely to change over time. And I should address a couple of questions that likely come to mind. One would be, why on earth do you have more than 50% of your net worth in startups and crypto? And it is not because I had 100 units of assets and decided to put 50+% of those units into crypto and startups. That would be complete insanity, I think, for almost anyone. It's because I started off with a very reasonable allocation. Some of you might remember that many years ago, 2008 or so, I created for myself a real-world MBA. Rather than going to a Stanford GSB or one of these graduate school programs of business, I decided to take the same amount of money over 2 years. At that point, it was $60,000 a year for 2 years, and invest that into the Tim Ferriss fund, in quotation marks, to try my hand at startup investing. In the very beginning, piggybacking and co-investing with people who knew what they were doing. And I assumed the network built, the skills developed, the knowledge acquired over that 2-year period of time would benefit me more than the $120,000, which I assumed I would lose. Right? The assumption was, much like tuition, that would be a sunk cost. And that then set me on this accidental career of being an early stage tech angel investor and advisor. And that tiny sliver of my total pie chart at that time, due to lucky/good investments and company selection, has swollen to a gigantic percentage of the total pie chart with companies like Uber, Facebook, Twitter, Alibaba, and so on. Crypto, very similarly, has not necessarily risen as it would have had I gone in early with something like Ethereum, but has nonetheless doubled and so on over time, more than doubled. So if you look at my cost basis, it was a very rational, well, semi-rational decision at the time to allocate what I allocated, but due to growth, they now represent a very, very large percentage of my total holdings. And the crypto can be freely traded. The startups are locked up. All right, so I am unable to decrease my positions and balance those for the most part. And that is why my portfolio looks the way it does. I would not recommend my asset allocation to really anyone.
Reflections. How I personally think about investing my money. When I reflect on this, I can think of 3 different buckets where I can invest my money. Bucket number 1, invest in yourself. The best investment you can make is an investment in yourself. The more you learn, the more you will earn. Warren Buffett. This bucket is all about growing your knowledge base and skills by learning from other people's experiences and discoveries. It can be very concrete knowledge that you already know is gonna be instantly useful to you, like for instance a workshop on how to run TikTok ads. And also a more broad kind of knowledge, like for example learning from the life of Charlie Munger or about mental models. And this can be very cheap because you can mostly find it on the internet for free or in books. A platform that I personally love using for this is Shortform, which is why I contacted them to create a long-term business partnership with Picking Nuggets. I think most people just go straight to the concrete knowledge that they need, but I think it's also important to be exposed to broad, big ideas because, in words of Steve Jobs, you cannot connect the dots looking forwards. You can only connect them looking backwards. So as you expose yourself to new ideas, you become more prepared. And as you become more prepared, you will be able to see more opportunities around you. As Abraham Lincoln once said, "I will prepare and someday my chance will come." I see this bucket as kind of like a meta bucket because improving your judgment by learning from other people is a critical component for attaining success in the following 2 buckets. Bucket number 2. Build your own asset. This is the entrepreneurial bucket, where you take your interests, creativity, and knowledge to build something from scratch, which will be successful if it's useful for a group of people. So in this bucket, you use the money to get the things that you need to start your entrepreneurial venture or make it grow. And the good thing is that nowadays it's not necessary to have a lot of money or good connections to bootstrap your business, because you can freely access to infinite leverage thanks to the internet. Also, I think that tinkering in the internet is much more aligned with the barbell model that we have seen, because in the internet, mistakes won't cost you any money or will be super cheap. And when you get something right, you can turn it into a highly profitable business. Whereas in the case that you are purely using capital leverage, your mistakes can be very expensive. As Mr. Beast commented in the Joe Rogan podcast, you only want to add the capital and labor slowly as you are proven right with your judgment. The absolute best resource that has helped me to learn the general principles of today's entrepreneurship is the 3-hour-long podcast episode of Naval Ravikant on how to get rich. Above, I attach a link to this episode. Bucket number 3. Buy other people's assets. This is about buying assets from other people that can potentially maintain or increase in value, and the investment is a means for passive income. As you probably guessed, my currently favorite asset allocation strategy for an investment portfolio would be the barbell model. There are 2 things I love about the barbell. The obvious one, the fact that I avoid the risk of ruin, because 80 to 90% of the funds would be in low-risk asset classes such as cash, high-grade treasury bonds, and real estate. As legendary investor Ray Dalio says, make sure that the probability of the unacceptable, i.e. the risk of ruin, is nil. And the other thing that I love is that for the 10 to 20% risky portion, it's okay if I don't calculate the risk with precision, because the most I can lose is that 10 to 20%. Whereas if I were to put everything into medium risk, I would have to accurately estimate the risks. And the thing is that it's almost impossible to do this, because we all have blind spots and we cannot predict the future. Personally, for my current circumstances and objectives, I'm mostly focused on bucket 1 and 2. But I do have a barbell extreme of around 15% of my little net worth, composed by highly volatile stocks, and now I'm also open to consider equity ownership through crowdfunding of private companies, or investing in the fine art market, which has now been democratized thanks to companies like Masterworks, which by the way is kindly sponsoring this video. Also, I try following Ray Dalio's advice on that the holy grail of investing is to have good diversification, as it can remove the idiosyncratic risk from your investment portfolio. But please do not take any of this as investment advice, as it is made for entertainment purposes only. Now I will expand a bit more on this mathematical property of Jensen's inequality so that you can get a clearer idea of how it works. Beware though that I'm not any PhD mathematician, just an average engineer, so please correct me in the comments if you see anything inconsistent. As the physicist Richard Feynman says, if you want to master something, teach it. So here we go. For Jensen's inequality to be valid, the function has to be convex. We have two variables. G of x is the function of x and it is a convex function, and x is a random variable. Having this into consideration, Jensen's inequality establishes that the expected value of the function of x is higher than or equal to the function of the expected value of x. As a little side note, the expected value is nothing but the mean or the weighted average. Let's illustrate the concept. We draw a convex line in the two-dimensional space, where the random variable x is at the horizontal axis and the function of x is at the vertical axis. Now let's locate 2 points in the x-axis, x1 and x2. Now if we consider that these points have equal probability of 50%, that means that the expected value of x is gonna be in the middle of both points. Beware though that Jensen's inequality is valid for any probability distribution, but we take the 50% just for simplicity. Now let's take the function of that particular point, and this value will be the function of the expected value of x. Now let's do exactly the same, but instead of using the x points, we will use the function output of those x points. So we take the function of x1 and the function of x2, then we can draw the linear combination of both points and locate the expected value at the middle. That will be the expected value of the function of x. As we can now see, the expected value of the function of x is higher than the function of the expected value of x. If we now say that x represents the risk level and the function g represents a benefit, we can clearly see how for a same amount of risk between risk 1 and risk 2, we will always get that the benefit is higher for the case of the bipolar strategy, because it creates a second line which is always above the convex curve. If you want to know more about Jensen's inequality, I highly recommend you to check the explanation linked above by MIT professor John Tsitsiklis. Now let's close Jensen's with an insightful quote from Nassim Taleb. Just as Stoicism is a domestication, not the elimination of emotions, so is the barbell a domestication, not the elimination of uncertainty. And now a quick word from today's sponsor, Masterworks. Right now, the ultra-rich are doubling their median investment into one particular market. Business Insider says demand has been insane for the past decade, but with 2022's volatility, CNBC says the ultra-rich may see this investment as a hedge against inflation, and perhaps a safer store of value than increasingly volatile stocks and cryptocurrencies. What market? The art market, but more specifically, the multi-million-dollar fine art. As an investment, its appreciation outpaced even the S&P 500 for the last 26 years by 131%. But if you're not a billionaire, don't worry. You can still diversify with art in an SEC-qualified way today thanks to Masterworks. Even as the stock market has fallen over 20% this year, Masterworks sold a painting for a 13.9% net return just a few weeks ago. That brings their last 3 sales to 13, 17, and 21% net returns to investors. And although past performance is not a guarantee of future results, it is pretty impressive. Masterworks has over 600,000 users and paintings have sold out in minutes. But you can use the link in the description for preloaded priority access.
Thanks for watching.